Good evening, everyone. Welcome to the weekly webinar Let's Trade Live, 6th of February. This is Wayne. On behalf of Fullerton Markets, I welcome everyone to the webinar. So as usual, the webinar will be divided into 3 segments. The first segment will look at what are the past events and news that happened for the past 1 week. And second segment will move on to the news calendar to look out for what are the news this week. And finally, the last segment will move on to the charts to look for trading opportunities. So feel free to type in your questions. I'll take the questions along the way as much as possible. So let's jump straight to it. So for last week, there are plenty of central bank news and government policies. So let's look at it one by one. The first one, of course, is Bank of Japan. Yes, they have maintained their interest rate unchanged at negative 0.1% and very much left the stimulus as it is unchanged as well. So they will continue their bond purchase as per normal. But towards the end of the week, we see some volatility in the yen, and the main reason is because there's some disappointment in the amount of bonds that is being bought by BOJ. That's why there's as you can see the chart screenshot below. This is from Bloomberg. So the chart below basically shows the Japan bond 10-year bond future price. Okay, take note, it is price. Later I'll refer to something called yield, which is the interest. So typically for bond, general knowledge, the bond price and the bond yield is inversely proportional. Meaning to say, if the bond prices goes up, bond yields goes down. And vice versa, if the bond yield goes up, it means that the bond prices goes down. So there's an inverse correlationship between the bond price and bond yield, just to take note. So what you see over here, the chart is showing Japan bond 10-year bond futures, which is the bond price. So you notice that when BOJ announced their 5 to 10-year operation, basically the market is quite disappointed. You saw the bond price drop drastically. So meaning the bond yield goes up. Another thing to take note of in terms of the correlationship between bond yields and the currency. Typically, they are positively correlated. So in this case, we are looking at Japan bonds. So the currency is, of course, Japan yen. So when the bond yield goes up, so does Japanese yen. So similarly, you notice, so the bond price went down initially. Okay, the first drop, it means the bond yield goes up. And when bond yield goes up, it means the yen strengthens as well. So when yen strengthens at this point, it means not a good sign for BOJ. They panic because it's a sudden drop, as you can see. It's like a free fall. So when the bond price free fall like that, it means the bond yield also skyrocket. And it means the yen strengthens quite a fair bit in a short span of time. That caused Bank of Japan to have some measures. So later on, as you can see, later the day, they decided to take some action to push the bond price up again. So basically, they announced plans to have plans to buy unlimited amount of 5 to 10-year bonds. So when they do that, the bond prices went up. So now you know the relationship. When bond prices goes up, it means the bond yield will come down. And when bond yields comes down, so does the yen as well. So the yen weakens. So that's what happened on Friday. So Bank of Japan whipsaw the market in tussle over yield control, as you can see the headline over here. So that's what happened to Bank of Japan. And the next one, of course, Bank of England, they announced their policy as well. So they maintain their interest rate as expected, 0.5%, no change. And of course, what you see over here is the sterling plunge after the market sees that BOE has no urgency in tightening. So of course, there's a change in terms of bias. If we recall in December, Bank of England is a bit on the hawkish side because of inflation is rising. So market is expecting to see some form of hints or possibly tightening in 2017. So that's what the market is expecting to get some clarity on maybe some positive confirmation on a possible rate hike this year. But instead, Bank of England went to say that yes, everything is going up, inflation is up as well, but there are cautions. They caution the implication of Brexit because at this moment, there's no way for them to tell what's the implication on their UK economy at this moment. So they are not in any hurry to tighten or raise interest rate, even though they see inflation rising. So that's their bias at this moment. So they are waiting to see the Brexit plan moving forward and what kind of implication it has on the economy. And the reason why they are holding back also because the recent data, especially for last week, we see the PMI, out of the 3 PMI, manufacturing, construction, services PMI, out of the 3, 2 actually underperformed. They came out worse than expected, whereas the manufacturing is just meeting the market expectation. So data is showing some slowing down. So that's another reason why Bank of England is not in a hurry to tighten at this moment. So that's so much for Bank of England. Of course, the next one is FOMC, the biggest news of last week everyone is watching out for and looking out for some clarity as to when is the next rate hike. So everyone is expecting 3 rate hikes this year prior to the meeting. But the Fed sort of noticed that yeah, they are still on plan. Economy is still performing healthily. So they mentioned that they are still looking out for a gradual tightening. Okay, gradual means in a slower pace, in a not in a very fast mode as in a back-to-back rate hike as expected. So like I mentioned 2 weeks ago, we do not expect a back-to-back rate hike. And true enough, they did not, and they are more dovish than what the market expected in terms of their statement. Okay, that's the main reason we see a sell-off in the dollar. They are so dovish in a way that the market are now scaling back on their rate hike expectation. So at the start of the year or even in December, market expectation is 3 rate hike, quite aggressive, 3 rate hike for 2017. So after the last FOMC, their market is starting to scale back to maybe 2 rate hike for this year. So let's see, based on the market analysts, the chances of a rate hike in March is down to 26% plus minus. Okay. So it is definitely less than half the percent chance of a rate hike in March. So let's see, moving forward, there are many of FOMCs coming up. So after the March FOMC, maybe is something that we should watch out for to get some hints of the next rate hike. So if they maintain their dovish mode again, then the market will continue to scale back on a rate hike expectation, meaning the sell-off in the dollar will continue. So that's so much for FOMC at this moment. So as you can see, the screenshot below is an interview by John Williams, one of the Fed president of San Francisco. So as you can see, the subtitle there, it says 3 hikes, reasonable guess. So the tone is not as firm. As you can see, it's a reasonable guess. So they are scaling back, may not be 3 rate hikes for 2017. Of course, the next news towards the end of last week is non-farm payrolls. Okay, we all know now that it increased by a big jump, 227K, which is 50,000 more than 50,000 above the market expectation of 170K. Very healthy job growth, but at the same time, you look at the unemployment rate, it went up 4.7% to 4.8%. Not a big deal if you look at the unemployment rate, because the participation rate went up as well. So that's sort of balanced things up. But what is worrying is the wage growth. Wage growth only came in at 0.1% versus market consensus of 0.3%. So wage growth is slower than expected. So all in all, if you look at non-farm payroll, it is still considered healthy, but not really fantastic, as in market will start to increase the chance of rate hike in March. So it is sort of healthy enough for Fed to maybe proceed with 2 rate hikes for this year. So that's what the last week's non-farm payroll is about. Okay, the next is something that I wish to highlight. As we all know, or those of you who have been watching out the news, there's a lot of news coming out from US, especially with all the policies and plans that has been unleashed by President Trump. So the latest I wish to highlight is this, as you can read from the headline, Trump to order Dodd-Frank review. So basically, Dodd-Frank is a policy that is being implemented by Obama. So I'll run through quickly, I'll summarize what is Dodd-Frank and what would be the possible implication to the financial markets. So I'll summarize into a very simple point. Of course, the Dodd-Frank is not as simple as that, but let's look at it. It was passed in 2010, which is about 7 years ago. And it is named after 2 US congressmen, just for general knowledge, Chris Dodd and Barney Frank. So that's why it's called Dodd-Frank. The purpose of this Dodd-Frank, of course, number one, is to prevent financial crisis like that in 2008. So the purpose of having the Dodd-Frank policy is to prevent a reoccurrence of the financial crisis that has happened in 2008. The other main objective is basically to protect consumers against the risky behavior of financial institutions. So this is the 2 main objectives. Of course, it is, like I say, it is much more than all this, but the key point I've summarized over here, what is Dodd-Frank about. The entire Dodd-Frank policies is about 2,000 over pages. So that's how complicated it is. Of course, it includes all the regulatory policies that binds the hands of banks, investment banks or depository banks, brokerages as well. So we all know that for those of you in the forex market long enough, you know that there has been a series of tightening regulations implemented on the US broker a few years back or during that time. So some of the regulation is like leverage cannot be too high, you can't have a hedging position and things like that. So what President Trump is going to do is going to review this Dodd-Frank. Okay, the keyword here is review. Is that it doesn't mean he will throw it out of the window, because to throw it out of the window meaning, as you can see, the two main aim over here is to prevent the financial crisis from happening again, and also to protect consumers against risky behavior. So if he throw out the entire Dodd-Frank policy, it means that there's possibility of 2008 crisis happening again, and also it means that he doesn't want to protect consumers. So the keyword here is that he wants to initiate a review on the Dodd-Frank. And why does he want to do that? Okay, everyone will be looking at, hey, is such a good policy. If it's aimed to prevent financial crisis and protect consumer, it should be a good policy to keep and maintain. Having tighter regulations, yes, you will aim to prevent crisis and protect consumers, but the other side of the coin would be it will bind the hands and legs of the banks. Thereby, the downside is reduce their competitiveness and flexibility. So for everything that is around, there's always two sides of the coin. There's always pros and cons. So the cons of Dodd-Frank, of course, is the competitiveness of all the financial institutions, and the regulations is being applied to other institutions who did not cause the financial crisis. So some of them are crying foul, is that, oh, it is not we who is causing the crisis. Why are we being penalized in a way? So there's always two camps fighting at any one time. So by President Trump initiating this review, I think the main aim, let's see, because there's no firm plans or details being released yet, what is to be reviewed, what is to be changed. What it means is they will initiate a review. So it depends on the actual review and changes made. And financial market definitely will react to it. Of course, if a lot of preventive so-called measures has been removed, then of course fear and panic will start to kick in. It's likely to kick in. It's like, wow, you remove all the safety measure, so what if the financial crisis kicks in again or happen again? So if too much of the safety measure or safety net is being removed, then of course the market will start to be fearful and be risk averse. But of course, if the change is pro-business, is improving the competitiveness of the financial institutions in US, making it more robust and improving their economy, then of course it will be beneficiary for the economy and the US dollar as well. So it depends, and of course a beneficiary for the equities market, because banks supposed to benefit from such loosening of regulation so that they are more competitive. So all in all, it remains to be seen what is to be released, the actual changes to be made, just to highlight this to you to watch out for. Of course, it will not happen overnight. It takes time for the team to go and review a 2,000 over page kind of policies, and then think of what to change, what not to change, and things like that. So that is basically what are the key events and things that has happened last week that is worth noting. Next, we'll move on to the next segment. We'll look at the upcoming news for this week. What are the data or the events to watch out for? The first one is tomorrow, Tuesday, 7th February, GMT plus 8, 11:30 a.m. Reserve Bank of Australia is scheduled for their interest rate announcement and their rate statement. So their current interest rate is expected to maintain at 1.5%. However, suggestion in case if the central bank decide to surprise with a rate cut. So this is a pending short Aussie dollar suggestion if the actual interest rate is less than 1.5%. So as usual, since this is preparing for a surprise, the probability of that happening is low. But if it really does occur, then probably there will be a sell-off in the Aussie dollar to catch your pending short order to take you for some profits. So that's the purpose for such a surprise trade suggestion. So this is a pending short Aussie dollar for tomorrow's RBA interest rate decision. Next would be on Thursday, way in the morning, GMT plus 8:04 a.m. There will be a Reserve Bank of New Zealand interest rate decision. So their current interest rate is at 1.75%. Market is expecting them to maintain interest rate at 1.75% as well. Although market is expecting some dovishness in their press conference statement. But a trade suggestion over here again, also pending short on Kiwi dollar if the actual interest rate is less than 1.75, meaning they surprise again by cutting interest rate. So if they do a surprise interest rate cut, it's possible to see the Kiwi dollar fall quite a fair bit to take the pending short for a nice profit. So that's expectation. Of course, since it's a surprise, the probability of it happening is will be low as well. But low doesn't mean it will not happen. We have been, for those of you trade the forex market long enough, central banks have not once or twice surprised the market by rate cuts or rate hikes. So that is Thursday, RBNZ interest rate decision. And next on Friday afternoon, GMT plus 5:30 p.m. there will be the UK manufacturing production month on month. So that is the data to watch out. The previous number is 1.3%. Market is expecting 0.5% only. So things has been slowing down for UK. So market is expecting only a 0.5% improvement in terms of manufacturing production. So the trade suggestion over here would be a pending short on pound dollar if the actual number comes in at lesser than 0.3%. Meaning the actual number is much lesser than what the market expected at 0.5%. So if actual number came in 0.2%, possibly the pound dollar may weaken to take a pending short order for a ride for some profits. So that's the last and the final suggestion for this week in terms of news. So before we move on to the charts to look for trading opportunities, so this is our accelerator bonus. So for those of you who have yet to take advantage of it, do check us out, fullertonmarkets.com/promotions. So you can get up to USD 10,000 for free. The terms and conditions apply, but it's very simple terms and conditions. You can read all about it on the link provided on the screen here. So let's move on to the charts. So for the charts, feel free to type in the currency pair or symbols, instruments that you want me to look at, and the time frame as well. Okay, there's a question over here. So before I take the request, let me take this question. What is your strategy of trading news? Okay, my strategy of trading news, of course, is on the surprise side, basically trading on the surprise. If, example, just now if you see the interest rate suggestion, market is expecting the central banks to hold interest rate. So when I trade on the surprise side, meaning I put myself in the direction whereby if the central bank cut interest rate, so cutting interest rate is not what the market is expecting at the moment. So it's sort of a surprise, the market. So that's my strategy. It is basically called a surprise trading. So how far should we put our pending order from entry and what time frame, stop loss and take profit? A very good question. To answer that question, the pending order would be placed typically 2-3 minutes prior to the news. So it is good because for such data releases, we know exactly what time it is. So we don't need to stare at the screen or wait there for half an hour or so. All you need to do, maybe if you need to log into your computer or whatever, you can do it 5 to 10 minutes before, set up your charts and platform nicely. And you can place your pending order just 3 to 5 minutes prior to the news. So you can do the calculation of how much lot size you will enter, where you will put your stop loss, etc. And for news trading, typically I will scale it down to a M1 or M5 chart to look at the consolidation zone prior to the news. So usually before major news release, the market tends to be very quiet. So when you zoom it down to a M1 or M5 chart, meaning a 1 minute or a 5 minute chart, you will typically see a range. That means the support resistance. So for a pending short example, so for pending short, typically I'll just place it 10 to 15 pips below the current price. So of course, prior to the news, the current price may move a bit, like plus minus 2 or 3 pips up and down. So sometimes I'll just place it 10 to 15 pips below the current price. And then of course, if you see that the price is moving towards your entry price and the news is not out yet, then you have to adjust your pending order accordingly, so that to shift it lower. So prevent your pending order being triggered before the actual data is released. So for news trading, it requires some practice and of course some experience in trading as well. So if you are new to trading, I would suggest that you practice with a demo account first when you trade during the news. So you are accustomed to the kind of volatility that you see before and after the news, and you can practice your reaction time, because to trade the news, sometimes you need to react fast. So for pending order, that's how far I typically put it, 10 to 15 pips away from the current price. Why I say 10 to 15 pips, it depends on the currency pair. So for more volatile currency pair like the sterling pairs, so typically I'll place the pending order 13 to 15 pips away from current price. For the less volatile pair, Aussie dollar, Kiwi dollar, then possibly I could take 10 to 12 pips away. That's good enough. So that's the entry price. Then of course for stop loss and take profit, it will depend on, again, the volatility of the pair and the news. Certain news are known to be more volatile. Example, during FOMC, during non-farm payroll. Then of course the stop loss, for my stop loss, I'll put it slightly wider to avoid any whipsaw and trade hitting my entry price and stop loss at the same time when spread widen and things like that. So for more volatile pair, I'll put my stop loss typically around the 40 pips to 50 pips region. And for the less volatile news and less volatile pair, typically my stop loss is around 30-35 pips. As for take profit, one easy way is for you to put a 1:1 risk reward. Example, if you put a 40 pip stop loss, you can put a 40 pips take profit. But for me, when I trade the news, typically I don't have a take profit. I will look at the 1 minute and a 5 minute chart to look at price action, how market behaves after the news. So example, I'll use the Aussie dollar RBA interest rate as an example. So my suggestion is to put a pending short if RBA cut their interest rate below 1.5%. So just 3 to 5 minutes before the interest rate announcement, I will prepare my pending order and place it about 10 to 12 pips below the current price. So when the data is out, if it is really RBA cut their interest rate, chances is the market will spike down quite significantly and take my pending order along. So market would have moved. But because I don't have a take profit, I will have to manually exit the position. But I will not exit immediately. I will watch the 1 minute, 5 minute charts to look at price action. So after the market move, it may retrace up and down for the first few minutes. Okay, for those of you trade the news long enough, you know that even though when market move in your direction, it may not move one way, it move in waves. So after it move like 30-40 pips, it may retrace 20 pips, that kind of thing. And it is very fast, all happening within seconds. So I'll watch the 1 minute chart. So as long as the market move in my favor, the first clue that I watch out for is 1:1 risk reward. Example, if I put a stop loss of 35 pips, as long as the market move 35 pips in my favor, I will move my stop loss to break even to the entry price. That's the first action I will take. Why do I do that? That is to prevent any sudden turn of the market. Okay, market is irrational. Okay, market is not rational. So anything can happen, even though the data is in our favor. Market may choose to react the other way. So as long as it is moved in my direction for 1:1 risk reward ratio, I will shift my stop loss to break even. Then I'll monitor the price action for the next few minutes. So as long as I see a pause in the price action for a couple of minutes, and what do I mean by a pause? Just for discussion purpose, if we look at candlestick, never mind the time frame, we look at the candlestick behavior, what I've marked on the chart, assuming this is a 1 minute chart. So after the price, let's say, move up, and then you see the price move in a sideways manner for a couple of candlesticks, that is considered a pause. So when I see such a pause, it means that market has already priced in the effect of the news. It is time for me to exit. So I'll close at whatever price it is. That's one option. Option number 2 is if I have a reason to believe that the price may move further. Okay, for example, RBA is announcing their interest rate in the morning. So Europe and US session is not open yet. So after the market pause, when Europe session open, there may be another round of rally or whatever. So I may choose to instead lock in or take some profit from the trade first. That means I do a partial close and then I leave the other position open and wait for the next move in my favor. Or worst case scenario, if it goes back and hit my stop loss, because I already shift it to break even, I don't lose a single cent. So that's typically how I will manage my position when I'm trading the news. Wow, that's a long answer for just a question. Anyway, let's move on to the requests. The first request on my screen would be dollar yen. Oh, there are multiple requests from same person. Okay, let me do a summary so that I can take the request of most people. Okay, I'll go straight to dollar yen H1 first. Okay, dollar yen H1. Okay, this is the dollar yen H1 chart. Okay, I'm going to mark some levels that I see over here. Okay, 112.20 seems to be the so-called support for dollar yen. So going back to the central bank policies, Bank of Japan is worried about the yen being strengthened too much. So even last Friday, they did something to prop up the yield, or rather to control the yield, make it lower so that the yen weakens. So definitely Bank of Japan is always looking, is not in favor of yen strengthening too much. But they are trying to do a balancing act in my view, or in our view, because Donald Trump has mentioned that he is not in favor of countries manipulating or intervening in their currencies to weaken their own currencies. Because if other countries are weakening their currencies, meaning relatively the US dollar will strengthen. And President Trump doesn't want dollar to strengthen too much. Obvious reason to be competitive. Because if the dollar becomes too strong, then it makes their exports less competitive, because it is more expensive for other countries to buy from US. So it is obvious what President Trump is trying to do is to maintain their exports. So to do that, US dollar cannot be too strong. So he is quite open to even negotiating currency manipulation in trade agreements. So at this moment, if I'm in the shoes of Bank of Japan, I don't want to be too obvious in terms of intervening or weakening the currency so that it gets into the radar of Donald Trump. Main reason because Japan, #1 export partner. That means Japan export the most goods to US. Okay, US is Japan's #1 export partner. So if they are seen being manipulating currencies too much, and Donald Trump decides to slap them with some tariff and something like that, it will hurt them as well. So in our view, we feel that Bank of Japan will try to balance things up, not to be too obvious in terms of manipulating or weakening the yen. But at the same time, they will not sit around doing nothing and just see the yen strengthening further, because they still have their country interest to look after. They have their inflation target to hit. So if the yen strengthens too much, that will be a challenge for them to hit their inflation target, and also will hurt their exports as well. So having said that, for yen to strengthen below 112, maybe, but BOJ will start to come in to support it, to prevent it from strengthening too much. That's point number one. And of course, on the other side, US Fed side, because market is starting to scale back on rate hike, that's why we see the dollar is weakening. So if you ask me to describe the situation, it's like a tug of war between US and Japan, the dollar and the yen, and both sides is trying to lose. So we know that tug of war, whoever is stronger will win, but in this situation, it's like a tug of war where both team is trying to lose. So it is in a quite interesting situation to see it. So having said that, dollar yen, we would expect the dollar yen to be consolidating. There won't be clear trend at this moment, at least for this week. Especially for this week, there's no major data expecting, both on the US and Japan side. So I do expect some consolidation for dollar yen this week. Having said that, I do not expect dollar yen to break below 112.20. So even if dollar yen close below, I'll exercise some discretion in taking a short trade. Instead of chasing it immediately, I'll watch how the market move after the break. So unless there's some news or announcement made that caused the break to happen, unforeseen or unscheduled release of news, if there's nothing after the break, if you go to Bloomberg or any news site and you try to search and there's nothing worthy to take note of from the US or the Japan side, no major announcement by Fed or President Trump's office or Bank of Japan, then possibly the break may not last very long. So unless you spot some major news that is causing the dollar yen to fall and could possibly fall further, then you can take the trade after the break. Else, I would suggest to exercise some caution in taking a breakout trade over here. Rather, I will wait for something like this to happen. After the break, price to push further down, retrace back up. So once it retraces back up, this is the time where I want to see whether it is a forced break or not. If it is a forced break, prices may move up further over here. And then if this kind of move is another fake move, then price is likely to move down again. So if the price move down again to this blue box over here, then this could be possibility for me to go short. Of course, this kind of move has to happen within this week. Things change very fast. So next week, we'll have to see what's the situation and decide on the next possible suggestion. So for now, dollar yen, this could be one of the possibility. If price close below, I'll zoom in so that some of you can see the chart better. So when the price close below this horizontal line, which is 112.20 support, close below, I personally would wait for something like this to happen. If it does, then that is a time for me to take a shot in the market. And then of course, the other possibility would be if if the candle did not close below, it's sort of with a shadow going something like this. The shadow just it's just a shadow that crossed the support, and then bounce back up again. Then possibly if the candle close into the blue box or higher, possible to consider to go long. So let me repeat. If the candle failed to close below the support and price start to retrace higher, and it closed above the last high of this candle, meaning it has to close into the blue box area. If it close into the blue box or higher, it's fine. Possible can consider to take a long trade. So that's dollar yen for you. The next suggestion or next request on my screen, Euro Pound Day 1. Okay, Euro Pound Day 1. Let's look at Euro Pound Day 1. Okay, this is Euro Pound daily chart. So for at this moment, if you look at both the Europe and the sterling, both are considered weak currency. So again, it is like another tug of war where both teams are losing. So it is, why do I say both teams are losing? If you look at the sterling, a lot of fear, even though sterling strengthened quite a fair bit recently. Main reason because market says that the Brexit fear or the Brexit implication on UK economy is not that near term. It may only take in effect 1 to 2 years later. So it is too early to sell the sterling. So that's why they price out the effect. The sterling strengthened quite a fair bit recently. And also because of the issue in Europe, as I mentioned in past webinars, there are ongoing elections scheduled for this year. And the major one is France, and there are a lot of political risks in Europe for this year. And when there's a lot of risks in Europe, UK is in a better position when it comes to negotiating all the trade agreements agreed once they invoke Article 50. So if it is easier for them to negotiate trade agreements, then it is favorable for the sterling. So that's another reason why the sterling remaining strong. Of course, the other side, if you look at the central bank, like what I've mentioned, they are not in a hurry of tightening. So that is sort of loosening the sterling a bit. People doesn't want to buy sterling because the central bank is not planning for any rate hike. So you have all these reasons coming together. It just means one thing: the direction of sterling is not clear. So if you look on Europe side, okay, Europe, their central bank is on easing mode, and yes, of course, the data in Europe has shown improvement in terms of inflation and all this, but central bank has played down attributing it to rise in oil prices. So it is not really a sign that their economy is improving as a whole in general. So they are looking at continuing the stimulus. They are not looking at tightening. So that keeps the euro weak as well. So now let us look at the euro pound. So having said whatever I've said in the past like 5-10 minutes, the conclusion is euro pound is likely to be in a sideways manner, if you ask me. So that's my conclusion for euro pound. If you are trading the daily chart, like this is the daily chart that you are seeing, will be a bit challenging for me to spot trading opportunities based on the way I trade. I don't see much of trading opportunities on the euro pound at the moment on a daily chart. So I'll try to scale it down to see whether there are any trading opportunities that I can spot. Okay, short terms wise, like I said, the euro pound, I'm expecting it to move in a sideways fashion without any clear-cut trend. So I'll mark the area for your consideration. So the area is around 0.8580. So this is to me the decision area. If the price close below it into the blue box, possible to consider to go short. Okay, I'll zoom in. Okay, this is how the chart looks like. And my suggestion, if the price close below 0.8580, possible to go short. Of course, the other way is if the price did not close below to the blue box and start to turn up, okay, when it starts to turn up to the blue box there, then possible to consider to go long. And some of you may ask, how do I decide that blue box? It's basically looking at the candlestick over here. So there's a resistance based on the body. If you see, all the body failed to go beyond it. So it is a indication for me that if the price can close above it, okay, to be precise, I'll shift the box higher. Yeah, if it close above the line over there, then possible to go long. Okay, this would be 2 trade ideas for your consideration on euro pound. Of course, towards the end of the week, do watch out. There are some key data to be released for UK that definitely may have an impact on this pair as well. But that is on Friday already. In case it triggers one of these and you are in a position, do manage it on Friday afternoon, GMT +8 afternoon, and do the necessary management of your position prior the news. So when I say necessary management, it could be shifting your stop loss to your entry price if your trade is in a floating profit, or if it is almost at break-even price, then you may consider closing out some of the position or all the positions to avoid volatility or risk during the news announcement. That would be another possibility. So this is what I meant by managing your open position. The next currency on my screen would be, okay, I'll take Euro Dollar H4. Okay, this is the next suggestion. There are a few requests on Euro Dollar, some on M15, some on daily chart, and some on H4 and H1. Wow. Okay, I will not go through every time frame. Rather, I'll just pick one time frame as usual. So let me just open the Euro Dollar chart. I will pick a time frame which I can spot some trading opportunities. So this is a daily chart. This is H4 and this is H1. The H4 is forming something like a head and shoulder, if you can spot it. Over here, very extreme. It went up, come down, went up, come down, and it goes up and coming down. So it is almost approaching the neckline of the head and shoulder. So if you just consider the head and shoulder pattern, I will mark the neckline as green color over here. So typically for head and shoulder, you will look at the neckline to typically decide your trade. So prices is breaking the neckline. So once it's broken, that means close. Let me just mark, this is the current candle. So it will close at in another hour or so. So once it closes, if it's really below the green line, that will be the textbook way of trading the head and shoulder. So typically it will close into, just looking at the price action now, maybe it will close into this blue box region here. So the textbook way of trading would be enter once the candle closes to go short. And for those of you trading the head and shoulder long enough, you will notice sometimes after price break the neckline, you will retrace up to around here before coming down again. It does this kind of movement. So if you have experience of such occurrence in your head and shoulder trading, then possibly you could wait for it to happen first. Then as it is coming down, you could take the trade at almost the same price as the textbook way of trading. It's still not too late. That's one way. Or you employ some candlestick formation kind of trading at this point. Okay, look for bearish candlestick pattern to take a shot. Okay, I'll write my comments here so it's easier to see. So the comments considered to look for bearish candlestick pattern to take a shot is at the top box over here. Maybe I'll change the color as well so that sorry, I just playing around with the color to okay, never mind. Yeah, the purple color box, that's where the area to look out for any bearish candlestick pattern to take a shot. Of course, the clue is if the price went higher than the last high over here, the red arrow, if the price went beyond where the red arrow high is, then it is a clue market is going into a range sideways manner. Okay. So other than that, I do expect based on price action, it seems like the dollar is strengthening against the euro at this point in time and may continue for the rest of the week. Okay, that's euro dollar H4 among all the time frame. I think this is the time frame that I want to trade. Okay, let's look at another suggestion. Kiwi yen. Okay, let's look at the Kiwi yen. The request is to look at M30. M30. Okay, for Kiwi yen, the major news of course happening on Thursday early morning GMT +8 time zone. So if you are trading the low time frame, there's still about 2 days, about 48 hours for you to trade. So for M30, to me M30 and H1 are similar charts if you ask, because 2 M30 candle is equivalent to 1 H1 chart. So usually I just look at the H1 time frame instead of looking at M30. But never mind, that is just my preference. So since the request is to look at M30, I'll look at M30. So the M30 chart has a very nice support over here. If we discount the fact this weird movement over here, Okay, this is too dark. Let me just whatever. Okay. So price is heading downwards again. You notice very strong bear momentum. So for those of you trading the candlestick pattern, in another 23 minutes, this candle should close. Then you will have a 3 black crow candlestick formation. So the 3 black crow is basically a bearish candlestick formation. So the next candle, you could possibly consider to go short. So based on this chart, okay, I'll just zoom out first. Based on this chart, I will discount the weird movement in the green box, but because for the rest of the other period or other time, it is respecting this area, pretty much this area, 82.10 plus minus. So to me, this is the decision, and market has already crossed the decision area to head downwards. So the next candle possibly can consider to go short. So that is the candlestick trading. I'll put my comments here. There will be the next candle over here. Then of course, for those of you has a concern of this last low over here, then if you think that the market may find support, even though it's only 1 point, but if you still believe that it will find support and price will turn up, then you can forego this trade and wait for price to go up and then break it before considering to go short. Of course, if you're someone that agrees with me or have the same view as me, to disregard this abnormal move, because most of the time market is respecting the higher level over here. It's only one instance whereby it some sort of broke and then go back up again. So if you want to share my view of this regarding this, then possibly you could consider taking this 3 black crow trade. So that's Kiwi yen, but leading up to like I mentioned, leading up to Thursday early morning, we are expecting RBNZ to be a dovish in their statement. So if they are dovish, that could push the Kiwi yen lower. But it depends on, at that point in time, how low is Kiwi yen. Because if market has already moved and priced in a dovish statement, then Kiwi yen may not move much after that. So it depends on how the market has behaved prior to the news. So this is Kiwi Yen for now. Very short-term trade happening, possibly happening in 18 minutes. Let me move on to the next suggestion, which is Pound Aussie H4 chart. Okay, let's look at Pound Aussie H4 chart. Okay, so this is the Pound Aussie H4 chart. Let me just look at. Okay, for Pound Aussie, there's a pretty strong resistance on the daily time frame. I'll just mark it there for my reference first. Let me put the price label there. A nice round number over there, 1.59. Okay, 1.59, that's the daily chart. I'm going to switch back to H4. Of course, because I switched the time frame, you don't really see the 1.59. I'm going to change the scale. There you are, the green line is basically where the level of 1.59, so that's the high time frame support. So for Pound Aussie, it is pretty much Aussie has a slight edge over Pound since China is doing not bad, and recently since the start of this year they have make move to strengthen the yuan. Okay, to the surprise, I would say to the surprise of President Trump, because he almost labeled them currency manipulator in a wrong way. Because now what China is doing, yes, they may be doing a currency manipulation as well, but it is in the favor of the US by strengthening the yuan. So if Donald Trump cry foul for PBOC for being strengthening their currency, then he is like firing a bullet on his own feet. So he should just leave PBOC alone to do their job. Because if the yuan weakens far too much since the starting of Fed rate hike speculation, that's why the US dollar strengthened quite a fair bit against the yuan, to the point of almost $1 to 7 yuan. So PBOC don't like, because the move is too extreme. So yes, a weak yuan will favor the exports, but they are undergoing reform to transform their economy to more consumption dependent. So having a weak yuan doesn't help in that sense. So in order to balance things up, now they are doing the opposite. Previously, they are known to be weakening the yuan in order to maintain their export competitiveness. But now, in order to for them to proceed with their reform and long-term plans, they have to do the opposite to strengthen the yuan, or preventing it from weakening too much. So it is actually good for the US if the yuan is stronger, so that China can afford to buy more US goods. So yes, China is improving, and because of strengthening of the Chinese yuan, their largest trading partner, or rather China is Australia's largest trading partner. Australia benefit as well. So Aussie in a way has a slight edge over the sterling. So having said that, I do expect sterling Aussie to move towards 1.59, but it depends on tomorrow. Okay, not forgetting tomorrow is still the RBA early in the morning. It is about 14 hours later. So from now until that time, yes, the pound Aussie may move, but I do not expect much of a big movement or trending moves pound Aussie, because depends on what RBA has to say tomorrow. If they are neutral or slightly hawkish, then or they say that rate cut is not necessary in the near future, then possibly Aussie may strengthen further, pushing the pound Aussie towards the 1.59. But of course, if they also want to maintain a weak currency, then they become more dovish, then Aussie will weaken. But at this moment, I do expect RBA to maintain more of a neutral bias to avoid too much volatility in the market. Because on the US side, there's enough uncertainties with all the Trump policies. So if they try to make too much changes of movement, that would only cause more complication. So if I were RBA or Reserve Bank of Australia, I would rather observe first, because at this moment there's no so-called necessity to make any move or change any bias at the moment. So I'd rather watch what is US side is going to do and what kind of implication it has to China and also to Australia. So chances is, I personally do expect RBA to maintain more of a neutral kind of bias in their statement. So if they maintain a neutral bias, and where else the BOE is considered dovish, this pound Aussie pair is likely to head towards 1.59 direction. So having said that, I'll be looking to go short. So the only question is when to go short. So this is a H4 chart. So chances is this suggestion will only happen after RBA. Okay, let me zoom in so it's easier to see. Yeah. Okay, the support is around plus minus 1.6260. So if it closes below, then possible consider to go short where the blue box is. Then the other opposite direction would be a bit tricky because price is pausing now, and just prior to it there's another pause over here. So if price starts to reverse to go up, the immediate resistance will be this area over here. So for me to take a long trade, I want the price to make a decision where it is going. So the area for me to watch out for would be here. So if candle closes around the 1.6415 area, possible to consider going long. And just for your reference, the below one is about 1.6210 plus minus. Oops. That will be the long and short. Suggestion on pound Aussie. Okay, let me look at another request. One final request. Gold, yes, I see a few gold requests. Okay, let me just quickly open the chart for gold. Gold, there's a request on a daily chart. Okay, this is the gold daily chart. It seems like the gold is reversing its trend due to the dollar weakness, and also because of a lot of uncertainty is being generated from all the Trump policies or plans that he's going to do. So it spurs the demand for gold, which is considered a safer asset. So as you can see, the gold price is heading upwards. Instead of looking at the daily chart, because I see on the price has broke higher. Okay, you can see the lower time frame H1 sort of price action. The market has already broke the resistance. The resistance is around 1224. So instead of looking at the daily chart and look for opportunity, if I zoom down to lower time frame, I may be able to catch the trade at an earlier time. So since price action already shown me that we have seen how the gold price has gone in the last 2 weeks. It is moving in wave, up, down, up. So I do not encourage chasing after the price now. It is not my style to chase after the price. I would prefer price to retrace back downwards, bounce up, then I will consider taking or following another trade. Okay, I'll zoom in and show you. Okay, go down, bounce up, then that's the place where I will consider to go long. So again, for gold, I like to highlight the volatility. You'll notice all this shadow over here. So these are the shadows that can easily take out any tight stop loss of placed by traders. So you'll notice there's a shadow, then market goes in higher, and then there's a shadow and then goes higher. So these are telltale signs for you to manage your position in case you want to place a stop loss. Take into account of all this shadow to place your stop loss. Of course, placing a wider stop loss has a disadvantage. It means the risk reward of your trade would not be as good. So there's always pros and cons, but I always have the thinking it's better to take a lesser risk reward than to get hit by a stop loss and the market move in my direction. So of course it depends on the instrument and the currency pairs that you are trading. It doesn't happen to all the instrument, so you have to understand the characteristics of the symbols and instruments that you are trading. And sometimes just by looking at the price action, you can roughly know the behavior of that instrument at that point in time. Okay, so this is a goal for you, and time flies. We have come to the end of the webinar. So again, for those due to time constraint, if I have not unable to take your requests, my sincere apologies. But anyway, for this week we have covered 6 charts. So before I end off the next webinar, a quick announcement. This Thursday, 9th of February, same time 8 p.m, we are going to have another webinar, our Trade to Win series. And this time round, I will talk more about bullion. Bullion will include gold and silver. So how to trade the bullion profitably? I'll talk about the factors that will affect the prices of bullion and silver. So do not miss out. This will be on Thursday 8 p.m. to 9 p.m. So if you have not registered for this webinar, do watch out. Go to our Facebook page. The registration link is published on our Facebook page. Okay, before I end off, let me scan through all the questions, see if there's anything that I need to answer. May I know when can I watch this webinar? By logging into Fullerton Suite, you can go to Let's Trade Live. All our past webinars are uploaded there. For tonight's webinar, it will be uploaded in about 2 hours time. So by 11 p.m. or so, if you log into Fullerton Suite, you can watch it live again. And of course, for the Thursday webinar, it will be recorded as well and made available in our Fullerton Suite. So on behalf of Fullerton Markets, I thank you everyone for your kind attention. May the pips be with all of you. And I look forward to seeing you all again next week, same time, same channel. So this is Wayne signing off. Good night and bye-bye.